Let's start with the topic provisions and reserves. Small topic, just need to learn the concepts, that's it. So, introduction. We assume that our business will continue for a foreseeable future and there is no intention to close its operation significantly. Means the production what I am doing today, I will do it even after coming 5 years, 10 years, and I don't see a situation where I will need to close down my business. So, to determine the net profit for each year, not only the current contingencies but future contingencies should also be considered. See, what is a contingency? An event when it occurs, it may raise such situations that you may have to incur some additional expense. Okay, so not only the current contingencies but your future contingencies should also be considered. That is not only for your current year but for also for your coming years. Provisions and reserves. Provisions and reserves are such considerations which actually relate to your future needs, for which a part of current earnings is set aside. Now I earn 100 rupees now, but I, instead of showing that actually these 100 can be distributed, I set aside 10 rupees and show that earning actually is 90, because I keep these 10 aside for my future needs. Okay. Now, learning more about provisions. A provision is the amount written off or retained, that is, it is kept aside by way of providing depreciation, renewal or decrease in the worth of assets, or retained by way of providing for the known liabilities. Underline the word known liabilities, of which the amount can't be determined with substantial accuracy. So, what is a provision? I know that this liability will occur in future. The liability for which I will have to pay is known to me, but the amount which actually I will need to pay, that I cannot say with accuracy. So you understood, I will keep some part of my earning aside for a known liability, but its amount cannot be determined with full accuracy. So such amount kept aside is called as my provision, and provision can be for depreciation, for renewals, etc. Now your concept of provision. Accrual assumption is a fundamental accounting assumption. So as it accrues, you have to account for all liabilities, losses and expenses, whether determined or not, should be accounted in the books of accounts to determine profit or loss for accounting period. Okay. The basic rule, you know what it is, that for whatever losses, expenses or liabilities, whether not fully determined, the amount is not known, but if they have to occur, account it in your books of accounts so that they show a true and fair picture of your business to determine the correct profit or loss, not for the income but for your expenses. The minute you come to know that there has to be a liability, account for them, but the minute you come to know that there has been an income, will you account for them? No, only when there is substantial binding contract that I will receive my income, then only you will account for the income, because that will unnecessarily increase your profit. But when you know that there has to be a loss, whether determined or not, the amount you may know or not, but then you have to provide for it in your books of accounts. That is a prudence man accounting method. So amount of liabilities which are not determined and recorded in the books of accounts should be best estimated to actual liability. Okay. So the amount which cannot be determined, keep it in the books of accounts with some figure that this can be the amount of provision, but do provide for it in your books of accounts. The amount so set aside is called as your provision. Features of provision. Provision is made to meet a known liability. I know that this liability to pay is going to occur, so I make a provision for that liability. Say provision for depreciation. I have an asset and at the year end I will have to charge depreciation on my asset. So it is a known liability. I have to make a provision for it. The amount of known liability can't be determined with reasonable accuracy many a times. For example, some debts will prove irrevocable, but the exact amount of bad debts can't be predicted with certainty. See, I make some sales which are credit sales. The people to whom I am selling will pay me money in future, so those people become my debtors, and debtors are assets for business. Now say that I have a debtor of 100 rupees, but I know that there will be some bad debts. Some debtor will become insolvent, he will have the power not to pay me or the intention not to pay me. Say 10% of my debtors will become bad, they will not pay me. 10% is my notion. Actually, what is going to become bad, I don't know. So only 90% should be recorded as my assets in debtors column. So what I will do is I will make a provision for bad debts, say by 10%, because exactly I don't know what will become bad, but I do know that something will become bad, and so I make a provision for bad debts. With certainty I can say that something will go bad, but the amount by which it will go bad I don't know. The amount is uncertain, so I make a provision in my books for bad debts. It is an amount set aside out of income or profits. So instead of saying that this is my profit, I will first subtract the provision and the net amount will come in my profit. Thus, it is a charge to your profit and loss. If my profit and loss is showing 100 rupees profit, subtract it by the provision and only the balance is my net profit. Importance of provision. To ascertain the true net profit of the business, because that liability has to occur, and so I am making a provision, so I am showing the true net profit to the public and not the increased net profit. To ascertain the true financial position of the business, I make provisions. To provide for known losses in future, I make provisions. For equable distribution of expenses, so as the expenses are there, record it when they are there. Maybe you don't know exactly what the amount is, but make a provision for it. Why do we make provision and what provisions? So why we know. Now what provisions? We can make provision for depreciation of assets, because at the year end we know that we will have to charge depreciation on assets, that is due to wear and tear of the assets or due to usage of the assets or due to efflux of time, the value of the assets goes down, and so from the value of the asset, the cost of the asset, we decrease the amount and charge it to your profit and loss account, which is known as depreciation. It is an expense for the business, although a non-cash expense, but yes, it is an expense and charged to your profit and loss account. No need to worry, this topic will again be discussed as a full chapter, depreciation of assets. Provision for taxation. So I know that I have to pay taxes, so better make a provision. Provision for bad and doubtful debts. I know that debtors are going to turn bad, some of them will not pay, so better make a provision right now. Provision for discount on debtors. Some debtors have to be discounted, they will not pay in full, so make a provision for that. Provision for repair and renewal of assets. Something or the other in assets keep or they need repairs and renewals, so better keep a provision. Now, since we have finished with the provisions, let's start with reserves. What are reserves? Reserves are the amount set aside out of the profits. So once you reach the profit, then from the profit you set aside something, that is your reserves. It is an appropriation of profits or accumulated profits to make stronger the financial position of the business. See, I don't know for what exactly this will be used, but then accumulated profits definitely strong up the financial position of the business. So sometimes the case may be that you know for what contingency are you keeping it aside, and sometimes it is just to strengthen the financial position. The purpose is also not known. So it is to set aside to meet known or unknown contingencies that may arise in future. Example of your reserve is, see, general reserve used for a journal purpose, capital reserve used for a journal purpose, but then dividend equalization reserve, specific purpose dividend, investment fluctuation fund, workmen compensation fund, reserve for redemption of debentures, reserve for expansion, reserve for increased cost of replacement, etc. Now they are all specific. Say there is a fluctuation in the rates and the investments rate fluctuate, so you need to have an investment fluctuation fund, and same way for any reason these funds, specific reasons, these are made. Features of reserve. It is created out of the net profits. Now once you reach to the net profit, after that what you make is a reserve or divisible profits. Such reserves are also termed as retained earning or undistributed profits, the profits in hand which I can distribute to the shareholders. So out of the net profit what I make is a reserve. Creation of reserve is not a legal necessity. It is not a legal necessity. It is created voluntarily for strengthening the general financial position of the business, for meeting unanticipated future event. So no law says, it is actually the decision of the management to make a reserve, not to fulfill any legal necessity, just to strengthen your financial position and to keep your business going. If something happens, I will not have to shut down because I have already put something in my reserves. Reserves, replacement, accumulated undistributed profits are available for distribution as dividends amongst the shareholders. You must have heard that I received dividend so and so rupees on so and so shares. So where does that come from? That comes from accumulated undistributed profits only of the company, right? So the purpose or the importance of the reserves is, it strengthens the financial position of an enterprise. Definitely it does, because from the net profit it is being made. Purpose is whenever an organization is in a difficult time, at that time you have reserves from which you can actually use and sail through that difficult time. Expansion, you want to grow your business, you can use that reserve. Better financial position, redemption of liabilities, meeting unforeseen contingencies. You don't know that some event has to occur that can shake your own base of the company, but if you have reserve, so you can at that time make correct decision, use your reserves, and you can meet that unforeseen contingency. Making dividends uniform from year to year. If I have reserve, I can keep a consistency. Some year the profit may be more, some year it will be less, but then if it is less, I can use a part of reserves, and then dividends can be equally distributed or uniformly distributed year after year. Meeting legal requirements. Okay, investment reserve required as per the income tax law. Some laws, as per the law, if the government requires some reserves need to be made, then they need to be made, then you can't question it, and that is the legal aspect. Types of reserves. What types of reserves do we have? Revenue reserve and your capital reserve. So in revenue reserve we have general reserve and specific reserve. What is revenue reserve? Set aside out of revenue profits which are available for distribution of profits is known as when some amount is set aside out of your revenue, that is day-to-day business profit, it is known as revenue reserve. And the two types are general reserve and specific reserve. When an amount is set aside not for any specific purpose, then it is a general reserve, also termed as contingency free reserves, as can be used freely, so this is known as your free reserve. And specific reserve, amount set aside for a specific purpose and can be utilized only for that purpose, is known as your specific reserve. Example is dividend equalization reserve. I want to distribute dividends equally year after year, so that is my specific purpose. For that, a specific reserve is made, known as dividend equalization reserve. Now reading on about the capital reserve. Capital reserve is set aside out of the capital profits not available for distribution as dividend among shareholders. So as capital, it will not or never be distributed among the shareholders. Example of capital profits are when you sell a fixed assets, you gain something out of it, then that is a capital profit, not a revenue one. Profit on revaluation of fixed assets. Sometimes the value of the asset increases drastically or decreases drastically. So at that time, what you do, you revalue your fixed assets. So out of it, out of the revaluation, what is made is profits on revaluation of fixed assets, and that is capital in nature. And same about for your issue of shares and debentures, again capital in nature. So summarizing, what is the source, usage and purpose of your revenue reserve and capital reserve? Source, created out of business profits or day-to-day profits. Revenue is always created from your business profits, and capital reserve is always created from your capital profits. Okay, usage, can be used for distribution of dividends without any precondition. So revenue reserve can easily be used for distribution of your dividends, but can capital reserve be? can be used for distribution of dividends only if it satisfies certain conditions of the Companies Act. This can be distributed without any restrictions or preconditions, but this capital reserve, before distribution you have to fulfill some condition mentioned in the Companies Act, then only you can. So purpose: for strengthening financial position and meeting unforeseen contingencies is revenue reserve is made. For meeting capital losses, since it is capital reserve to meet capital losses or for other purpose specified by Companies Act only, you can touch the capital reserve. Now your reserve versus provision. So provision is a charge on profit, whereas a reserve is a appropriation of profit. We have read this, that it is a charge on profit, whereas a reserve is appropriation of the profit. The purpose of the reserve is to strengthen the financial position of the business or meet the unforeseen liabilities. But whereas provision, we know what the liability is, it is not unforeseen. So to meet known liability or contingency, if the amount is not known, although the liability is known but the amount is not determined, we make a provision. Effect on profit. So it is debited to your profit and loss account, so the profit is reduced. Once you subtract the provision, then only you get your profit, final profit. But it is debited to P&L appropriation account. We make a separate account, P&L appropriation account. So profit is not affected in case of a reserve. Investment. It may be invested outside the business. Okay. Reserves can be invested outside the business, but provision cannot be invested. It isn't invested, it is kept aside. Distribution. Unutilized part can be distributed as dividend. You are free to distribute it as dividend. It reduces your divisible profits. But can this be distributed? I know I have a liability to pay, but I just don't know the amount. So how will I distribute it? Cannot be used for distribution of profits or dividend. It reduces my net profit. Compulsion. Creation is discretionary, but for provision there is a legal compulsion to make it, because you know that there will be a liability to pay as far as your provision is concerned. Presentation. How do you present it? So the reserves are shown as liabilities side of balance sheet under your reserve and surplus account. Here for your provisions, they are shown either as liability under current liabilities or as deduction from your asset. Why a current liability? Because I know that I need to pay it, but I just know that I don't know the amount. So a current liability or subtracted from the value of the asset will give the same effect. But this is the reserves is shown as liabilities side of the balance sheet under reserve and surplus.